Hey guys, welcome to class number 9 of our beginners day trading course. This is Mike with Vant Trading. We're going to be really jumping into technical analysis today and all this week. We're going to break down charts, support, and resistance. And what we're going to do is we're going to change things up a little bit, and we're going to have Nick step in and do the classes, at least the first 3 classes this week. He is our head equities trader at our fund, and he's going to take that off. And the fourth class, the last class of this week, obviously falls on Thanksgiving. So what we're going to do is we will be pre-recording that class. We'll try to get it out on Thanksgiving, but it'll definitely be out by Friday. So you can look at that class and log in anytime you want. And again, we're glad to have you here, and I'm going to turn you over to Nick and get us into this technical analysis.
Alrighty, thanks for the Passover. I'm double checking. Yep, you can all hear me, so should be ready to rock and roll. So it is Nick here. I am going to be your Sherpa, your guide, your teacher here for the next 3 classes. We're going to start off with some beginner stuff, some introduction stuff. A lot of you may be looking at this, well, I know charts. I know what a support line and resistance line is. And I'm going to counter that by saying, well, do you really? Do you really understand what support and resistance really mean in the marketplace? And do you know exactly how you might want to trade that, what that really means? And I'll go over some setups. We'll actually go through some charts towards the end. We'll talk about some phases of stocks. We'll actually give you a little bit of technical analysis insights, a little bit of setup stuff. And we're really just going to hit you with the fundamentals and bases here, because I really want you to walk away with being able to understand, well, how do I read the market? How do I read the psychology of the market, or of this stock that I'm trading, or whatever instrument it may be? This can be applicable to anything beyond stocks. So let's rock and roll here. Let's get started. This whole week is going to be technical analysis. It's going to be technical based. So we are going to be diving into more and more complex stuff as we go along, but you need to understand today's lesson before you really can move on to the rest of the stuff, because what we talk about today, support, resistance, what technical analysis is, how to read charts, is really the heart and soul of what we are as day traders and what we are as investors and traders in general. And a lot of things are based off of what we're going to be talking about today. But first off, as we do on these shows, we're going to talk about our habit of the week. And we've decided that this week's habit is going to be relentless, or I guess in this case, relentlessness, being relentless. And the quote I chose for this lesson was, "We will be relentless in our pursuit for perfection. We won't ever be perfect, but in the process, we will achieve greatness." And that is from a very famous coach here in the U.S. called Vince Lombardi. And it is really, I think, a key lesson for the class, really, and for trading, because you need to be relentless in your education and in your pursuit of becoming a successful trader, because it really, really is a marathon. There was another quote that I wanted to bring up, and that was from Danica Patrick. For those who don't know, she is one of, I believe, actually still the only female NASCAR driver. She blew up for a little while in the U.S. and became really popular. And she said, if you want to be in the best in your industry, you have to have a relentless dedication to your job. And it's very true. I mean, I will go through a couple personal life examples. I've been trading for, about 6 years professionally now, and a couple extra years, semi-professionally as a college student. And I've seen several hundred traders go in and out of New York offices, and I've seen the dedication and relentlessness it takes to achieve that perfection and achieve that greatness in trading. And this is the actual kind of Webster's dictionary term of relentless that I pulled up, just showing or promising no abatement of severity, intensity, strength, or pace. I mean, you need to be relentless in your pursuit of knowledge. If you want this to be your income, you cannot stop. I want to ask you, this is a pretty common, partially cliched thing to say, but do you know what the strongest force in the universe is? It's compound interest. And not just compound interest in a monetary sense, but compound interest in learning and in time. And the more you kind of escalate that curve of knowledge, and the more relentless you are, the faster your learning will be and the faster you will move along. We want to be building habits now. We want to be building the core and the foundation now. So that is why this week's term is relentless. And I want to mention a book, and I didn't know about this book until this week. I actually listened to the audio version of it, and I bought a paper copy of it. And it is Relentless: From Good to Great to Unstoppable. It is from Tim S. Grover. For those who don't know who he was actually the personal trainer for Michael Jordan. I would hope if you even relatively know sports at all, you would know who Michael Jordan is. And he also runs a place in Chicago called Attack Athletics. And what he would do is he would be the personal trainer and rehabilitator for a lot of the greatest basketball players that have ever stepped onto the court. And we're not just talking about these people as, just having that great natural talent. We're talking about these people as being fierce competitors. I mean, these are examples of the elite of the elite. And in this book, he talks about kind of that mentality and how relentless they were. I mean, it's the title of his book for a reason, as it focuses on these greats, and more specifically on Michael Jordan. They are relentless in learning. Mike's already talked about this in some of his classes, how, Michael Jordan would step onto the court and he's already replayed the game about a dozen times in his head before he's even gone out there. Tim S. Grover talks about at Attack Athletics, if a superstar like Dwayne Wade was injured, they would come to him and they'd rehabilitate at his center for, a month, 2 months, 3 months. He would have to literally threaten these players to step off of the practice court. They were not done with his process of rehabilitation, but they were so relentless in getting out there and practicing shots and layups and driving to the net that he would literally have to threaten to kick them out and go to some moshmo doctor out there who wouldn't be able to heal them properly if they didn't get off the court. They had this ungodly fire. He also talked about this relentlessness, and he's pretty extreme in some of his views in that, being truly relentless, they had to apologize for nothing. And they don't have to apologize for that fire, for crossing some of the lines they do, because they are absolutely elite. And, this is kind of the process that you almost need to kind of try to strive for in trading. I'm not saying, you're going to be the Michael Jordan of trading, but if you can strive and put in those habits, you could be the Scottie Pippen of trading, get a good couple championships under your belt, to continue with this metaphor, and really make a living in the markets. So let's actually kind of relate this now to trading. Well, what does it mean to be relentless in trading? Well, I want to tell you right now, I hate to burst your bubble. Trading is a marathon. It is not a sprint. And, some people would be like, well, Nick, you've only been trading professionally for 6 years. How would you know, the ins and outs of something like this? Look, I'm going to tell you that in my time trading professionally in New York City at a prop firm, I saw maybe 200 people come in as new traders. I also saw about 195 of those traders leave before I had moved back down to Maryland to trade back at home. So I am serious when I am saying that in those almost 5 years I was trading in New York, they would bring in about 2 classes. Almost every single person is gone within a year because they try to sprint and they exhaust themselves, they blow out their account, or they give up and they don't spend that time. Trading is a marathon. You need to spend the time building those habits, building that knowledge base, because if you get out there and try to swim with the sharks, you are going to get in a blown out account. You're going to encounter a trade that you have no idea what's going on. And look, big losses will happen. It's absolutely part of the game. You need to be relentless through those as well. And you also need to understand that the day you take off could have been the day that you hit it big as a trader. And I'm actually serious about this. I've actually got a real life lesson for you here. When I was trading, it took me a year from the beginning of trading profitable. I started in August, and it took the following August for me to kind of realize what I was doing and actually turn my account green. I spent a year of learning and slowly losing money, but not losing too much. And one day in August in 2015, there was a flash crash in the market, and the market absolutely tanked. You'd probably be able to pull it up on the charts and see the wick. And all of the stocks were tanking. Disney, Apple, everything was absolutely crashing, and no one had any idea why. There was no headlines. Thankfully, I was also on a floor with a lot of other traders, but I spent that time, I was prepared, and I made my largest day ever. It was only a year into trading. I made $16,000. It made back all my losses in one day over that past year. And from then on, I was actually pretty consistently profitable, and I've been pulling money from the market since. Now I'll give you another example in that same day. One trader who sat next to me was on vacation. He missed the flash crash. Now, he was not a new struggling trader. He was about a mid-tier trader, but that was a day that could have made his year. That was a day that could have made his quarter, who knows? You know, he wasn't at the desk, and I guarantee you he did not go on vacation without bringing his laptop with him since. So it is just a great example of, you know, there are going to be moments where, you know, yes, look, I'm not saying you have to sit there and be in front of the screen every day, but to take an excuse and say, well, I'm going to take today off and go kick back, you can, but you got to realize that you need to be relentless. I also want to tell you that, you know, there are going to be dry periods. There are going to be moments where you have no idea what the hell you're doing. You're going to feel lost in the markets. Those periods happen to all traders, experienced and not. There's just times where you're just not quite feeling what's going on in the market. Maybe the market environment's changed. You haven't quite identified how or why. Maybe you've gone through a period of low volatility. I don't know, but that's going to happen at times, and you just have to grind through it. You have to identify, adjust your trading, and make your way through it. I also want to mention that you will learn in this market every single day. If you take a single day and you trade in the market, there will not be a day that you don't learn something. Every day you miss is a day you could have learned something that otherwise would have saved you from a big loss. Maybe you go and trade today and, you know, you trade lightly, you don't do too much, but you see this really interesting setup in a certain stock. And then a week later you see almost the exact same setup, the exact same manipulation, or the exact same pattern. Patterns repeat themselves in this market. And, you know, if you had missed that day, you wouldn't have realized that trap that was being set out there by HFTs, or you wouldn't have seen that setup and you wouldn't have known what was going on. This happens. I also want to just quote a person that we like to listen to pretty often here. His name's Jocko Willink. He is an ex-Navy SEAL guy. He's super into it, super motivated. And he talks about going to the gym. And he says, you know, what do I do on the days that I'm just not feeling it? He says, I get up and I go anyway. Even if he's just going through the motions, he goes through the motions. You want to do that in trading. I'm not saying if you're not feeling trading or you're not feeling the market, you don't have to put money out there, but you should still be watching. You should still be reading, researching, doing something to further yourself. Like I said, when I first stepped foot onto a trading floor in New York City, I sat down with one of the head traders there, and he sat down and he looked me in the eye and said, look, we're not paying you while you're here. You know, you get straight commission. And I'm going to tell you right now, that's what entices people to try to sprint to the finish line and blow themselves out. Because he says it takes 1 to 2 years for most traders to finally get it. And that can vary, obviously. There are some traders who come out and maybe they've really prepped, or they had previous experience in blackjack or athlete. You know, they're athletes and they have a really good mental game or something like that, and they do get it quicker. This isn't a cookie cutter scenario. Some people take longer, but they do finally get it. The key here is you don't blow yourself out and you don't try to push yourself too far in that learning frame. You know, it sounds weird that something would finally click for you, but it does. You know, you finally start to see, my God, you know, these patterns are repeating themselves, or I'm actually starting to get some strategies under my belt that work. Now I have a little bit of a trading arsenal. You're not going to do that after looking at the markets for a month, because you know what? Markets change month to month. Environments change month to month, and you need to be able to eventually really get that knowledge base. After a year, like I said, you know, that's when I finally kind of got it. And there were traders after me that got it sooner and got it quicker. And I don't care, because if they got it quicker than me, I still got it. Doesn't matter. The trading, and I really like this. People talk about success being, you know, opportunity, or preparation meeting opportunity. That's really what trading is. The more prepared you are, the more rehearsed you are, the more you know your levels, your setups, you know the news catalyst, you know what's going on in the stock. The moment that that trade scenario hits, or that setup hits, that breakout hits, the more prepared you are, the better you're going to execute on that trade. You know, if I looked at the stock chart 5 seconds prior to the open versus if I spent an hour and a half, 2 hours prior, you know, putting my levels and understanding my game plan, you're going to be able to execute. So you need to be relentless throughout the day. You need to be relentless in your review, in your preparation. I know several traders at that floor, and I can tell you some of these guys were making 6-7 figures a day in some cases. They were making obscene amounts of money. And you know what those guys did? They showed up the same time every day. They were there well before the market opened. They were looking through their processes. Just because they were making 6-7 figures a day, they didn't think, oh, I can start showing up at 9 a.m., 9:15 a.m. Hell no, because they could have come in and suddenly looking around and like, holy shit, what's going on today? Something is not, something weird could have been happening in the market. They weren't prepared for it, and now they aren't capitalizing on a unique opportunity in the marketplace. There was a very unique trader that I had the pleasure of sitting next to. He loved trading mergers and arbitrage and all of these crazy things where one company's buying out another and you play the spread. Do you want to know what he did to prepare for those things? Every day he read pages and pages and pages of SEC documents. I mean, I'm talking the blandest, driest material that you could probably ever imagine. And, I'll be honest, that was kind of his personality. So you need to have something that fits your personality. But he would spend hours doing this, and he had an incredible edge in this. He would be able to calculate the probability of mergers going through, and he had all of these things memorized down pat, and he made a lot of money doing that. And he was one of the only people on the desk who had that amount of success trading that kind of setup because he spent the time preparing. One other thing I want to mention, if any of you have ever read the book or heard of the book Outliers, they talk about the 10,000 hour rule. You're not going to be, a master at something until you spent 10,000 hours working on it and learning on it. If you even think that's remotely true or half true, even if you think you have to spend 1,000 hours doing something, that's still 3 hours a day, every day for a year. So why do you think you're going to be a master at trading within a week, within a month, within 2 months, if you're not willing to wait until you've accrued kind of this mastery, these hours, this repetition? I'm just trying to lay out the realism for you here, and the example that this is a job, this is a career, and you need to take the time to master this. So one last slide, and then we're going to actually dive on into the technicals here. Talking about being relentless, some things that really help is having clear vision and goals. We've talked about this. I'm not going to hit you over the head again with having a vision statement and stuff like that. You should know that by now if you've watched the other courses. I do want to say balance is necessary, but you can't use them as excuses. Go out and go to the gym, go for a walk, talk to someone, do whatever you need. And like I said, blowouts and big losses, they happen. I've seen the big and best traders. They make mistakes. We are not perfect. You're not going to be a machine at trading, but they are relentless through those mistakes. They understand that, one guy that I was talking about, I saw him lose over $1 million in one day. It was $1 million in one stock ticker in one day. And, he was absolutely rattled. He didn't just shrug off losing $1 million in a day. I'll be honest. I'm sitting, a couple rows over in this floor, and I'm like, holy shit, this guy just lost $1 million. I mean, yeah, he makes that, more than that in a year, but that's going to be serious time to make that back. He went right back to work the next day. And I want to say it maybe took him about a month or two, but he did make that money back. And then he ended up continuing on that streak, and he had one of his best years ever, despite having $1 million loss in one day. So, being relentless through that, and I'm not saying being careless, you got to understand the difference, obviously, but, that's just kind of the determinism and the attitude that you need to have. I know about, a trader who was, on this desk, and he was an options trader, and he swung incredible position sizing. And I asked our floor manager, who interviews all the traders and learns about their background, who is this guy? Because he's like 65 years old. He smokes like a chimney. He's always got ear pods in listening like Kesha or something. And he trades massive size, and he's unbelievable. Well, it turns out that before coming to the desk, he was a trader, blew himself out, was homeless. He borrows money from his doctor. And he goes to his doctor and says, let me borrow money from you. I'm going to grind it back. He makes his money back and then some, regains kind of his composure, his attitude, and makes his way onto our trading desk and is lighting it up. I'm sure he's still there lighting it up. I don't know. I haven't talked to those guys in a little while, but, he's an absolute monster. And, I'm not saying, you're going to be homeless if you try to do this, but hey, if you try to do this incorrectly and you try to rush things, you might be. So let's dive on into it now. It's enough about being relentless. I'm done being relentless about being relentless. So let's talk about the actual stuff. We're here to talk about some of the actual technicals of the market. Let's talk about technical analysis. What is technical analysis? Well, it's reading the market. It's actually looking at the charts and reading the story that the markets are telling you. And there was a really interesting quote here that I saw and I really liked, and I thought it was very apt. For me, technical analysis is like a thermometer. Fundamentalists who say they are not going to pay any attention to the charts are like a doctor who says he's not going to take a patient's temperature. That is a very apt description, in my opinion, because that is what the charts are. It's what the price is. Price is king. The price is the direct reflection of the temperature of the market. If the market is dropping, your patient's got a cold or a fever or something. Something's wrong. And if you aren't looking at the charts, if you don't even pay a lick of attention to technical analysis, you're missing a part of the picture. I hate to break it to you, but you are. So what is going to be the goal of this? The goal of this is to give you a solid understanding of market dynamics so that you can deploy your own market edge. I want you to walk away at least having an understanding of, that you need to know what motivates the majority of the participants. You can't move the market on your own. I don't care how much money you have. You can't do it. And so you need to use technical analysis as a way to try to determine what is motivating the participants in the market. Why is the market going up? Why are there buyers stepping in here? Why are there sellers hitting at this level? And that's what we're going to be addressing. Now, before I actually dive into technical analysis, we need to also identify kind of its counterpart here, and that's fundamental analysis. I'm not going to dive into, all these different ratios and things like that, but I want to give you a core understanding of the differences in philosophy here and how they aren't as opposing as you may think. Fundamental analysis, for those who don't know, is simply using the business, financial information, the corporate health, the competitor information to value, quote unquote, the company. And then, if you're trading with fundamental analysis, you're buying or selling a stock based on the price that it's trading at compared to the, information that you've gathered and formulated. There's all sorts of ratios you can use. PE ratios, earnings per share, PEG ratios, debt to equity, ROI, ROA, all sorts of crazy ratios you get from looking at income statements, balance sheets, and cash flow statements. All of this stuff, you're actually looking at the health of the company and you're using that to value it. Now there's a whole nother side of things, and that's technical analysis. But first let's talk about, why would day trading with fundamental analysis be good? Well, like I said, fundamental analysis is the literal health of the company. It's going to be good to know if that company is, dog shit, or if it's burning cash, or if that company is a sleeping giant and, you might be in it early or something like that. You can use fundamentals to help choose the stocks you want to watch, or, which ones to prioritize on your watch list, or which ones you may want to, put on a certain list and short and buy and yada, yada, yada. You can use fundamental analysis to find competitors and sympathy plays and so on and so forth. You can use fundamental analysis to help find undervalued stocks. So there is good aspects to fundamental analysis. I don't care if you think it's malarkey and you think it's crap. There is basis in it, and we'll talk about that a little more. First off, as a day trader, what is bad about fundamental analysis? Because look, if you're a day trader and you try to rely solely on fundamental analysis, you're going to get hurt. And that's because companies can completely disregard fundamentals for a long time. And the market will blow you out if you are stubborn about the fundamentals. Let me just give you an example. Tesla, for years, has had a price-earnings ratio of 0. Since its inception until, I believe, this year, Tesla has lost money every single quarter. Except for the last 3 quarters, it has now gone to a PE ratio of 983. Now, if you don't know what that means that their price is 983 times the value of their earnings per share. They are trading at an extreme multiple. You never see something like this ever. In fact, Tesla currently has a larger market cap than the entire U.S. automotive sector combined. Tesla owns like 1% of the market share. Now, yes, some of that is forward-looking. It's anticipation. It's hype. But let's be honest, this has blown out its fundamentals to an extent. And anyone who may have been stubborn and tried to short all along this way has lost everything. Even if you try to day trade and short this thing every single day. Let's talk about something else. The quarantine stocks. We're recording this obviously in 2020. A lot of these stocks have gone up massive multiples in price in less than a year. Zoom was trading at $62 last year. It's trading at $600. Peloton from $17 to $140. OSTK, it was a $2.53 stock in March. It peaked at $128. Fastly was a $10 stock, $10 a stock price stock, and now it's 136. Have these companies increased in value by multiples of 10? No. Are some of these definitely more worth more and have better fundamentals and, have generally better market share because, we've become more work from home focused? Absolutely. But look, some of these have absolutely blown out their fundamentals. And if you used simply fundamental analysis to day trade, you're going to hurt yourself because you are missing out on the key there, and that is price. And that is understanding why the market participants are buying, where they're buying, and where the buying and selling is subsiding. So let's dive on in now to the actual part that we're talking about, the technical analysis. And why do I say this is the 10%? Well, just to remind you, to the courses that Mike's been talking about so far, the mental game is 90% of this. But this is the 10%. You don't want to go in with just the mental game because you'll look at a chart and wonder what the hell you're looking at. So you obviously need the 10% as well. This is the technical knowledge. This is, for some, this is the juicy part. This is the part that they're excited about, but you need that 90%, obviously. Now, technical analysis at its core is literally just reading the market and the price. It is the study of price and volume. I underline volume there because that is the, kind of the forgotten stepchild of the market. It's something that people don't really look at. And if you're a technical analysis trader, you don't look at volume, you're making a mistake. We'll talk about that a little more in a second. But technical analysis is really using the past to help gain an edge in anticipating the future. We're not predicting here. You're not trying to buy, catch bottoms and sell at tops. We're trying to anticipate, get an edge in our favor by looking at price patterns, looking at supply and demand, looking at technical levels here, and reading the chart. So why should you care about technical analysis? Well, price is king. Price pays. The fundamentals and valuations, like I've said, have gone completely out the window. When I went through college, was a finance major. I got in arguments with my finance professors constantly because I always traded with technical analysis, and they said, well, the PE ratio in our valuations are saying it's at its fair value. And I'm saying, yes, if we were in an absolute vacuum, fundamentals would be the only thing you need to worry about, but you need to understand that the market is comprised of irrational participants. You, me, the people who code the algos, the big traders, were irrational. We aren't trading this thing based on value. We're trading it based on hype or momentum or supply and demand or some other, immeasurable force that isn't reflected in the balance sheet and in the income statement. Tesla's not going up on fundamentals. Tesla's going up because of irrational or excited participants. And I'm not saying the participants are wrong by any means. The stock is the stock and the price is the price. And technical analysis focuses on the price and the participants. And remember, as a day trader, you are the small fish, and technical analysis will help you see the big picture. It'll help you visualize what the big participants are doing, and you can see what's going on. Nice little quote here from Stanley Druckenmiller, Duquesne Capital. I never use valuation to time the markets. I use liquidity considerations and technical analysis for timing. Valuation only tells me how far the market can go once a catalyst enters a picture to change the market direction. The catalyst is liquidity, and hopefully my technical analysis will pick it up. So, he's really... Stanley Druckenmiller isn't just a technical trader. He runs a very massive fund, and they are buying and selling very heavily based on fundamental fundamental basis. They're not, buying some Momo stock for this large corporate hedge fund that everyone watches and pays attention to. No, they're buying key stocks, but they use technical analysis to gain an edge. And this is why I want to talk about how you can marry the two. And you can kind of, some people kind of scoff at this techno fundamental analysis. Well, look, fundamental analysis is usually largely going to take precedence in a long run. If there is a stock, a BS company that's being manipulated higher, eventually that company will run out of money. I mean, look at MoviePass. MoviePass was momentum and manipulated all over the place, but they hemorrhaged money forever, and I think they delisted now. Look at Hertz. Hertz had garbage fundamentals, and they went bankrupt and liquidated. I don't care, that they may have been setting in support at some point. They went insolvent and they liquidated, so keep that in mind. Now, technical analysis, even if you're an investor and a swing trader and you don't care about the technicals, it should still be used to hone in your entries and exits. You can't argue that you can see where other participants are buying in the market by looking at the charts. You physically can. And if you can save yourself an extra 50 cents, $1 per share on your entry just by looking at that, it's absolutely worth it. Now, obviously, technical analysis is going to have more influence on the short term. We're day traders. This is a day trading course, so this is why we're focusing on this. And so really employing both is the most ideal in our opinion. So things to know involving technical analysis. Well, the market is a discounting mechanism. It's going to discount the past and anticipate the future. This is going to diminish the value most people trade off of. And you need to also know that price kind of moves in trends and patterns. There are ebbs and flows in the market. People price in things. The market's going to be anticipating news. That's why, in some cases, news might break in a stock and it hasn't really moved that much because maybe they've talked about it earlier. The market's already expected them to have good earnings. Obviously, people expect Amazon and retailers to have good earnings going into Christmas or going into Black Friday. So that's going to be priced into an extent as it runs up into those events and things like that. So, and like I said, there are trends and patterns. I'm going to talk about some of those trends and patterns in a moment and give you some chart examples. And here's a very apt quote. I talk about this all the time, and I quote it all the time from Mark Twain. History doesn't repeat itself, but it rhymes. This is very true in trading, and this is literally technical analysis in a quote. The history of a stock isn't going to repeat itself. It's not going to do the exact same thing necessarily, but pretty often it's going to look pretty similar, and you're going to start to see those patterns. So what are some key beliefs of the markets when it comes to technical analysis? No one, and I mean no one, I hate to break it to you, you soothsayers, you holy grail sellers, whoever the hell you are, no one can predict the markets. This is why 85% of fund managers can't even beat the S&P 500 in a year. That number gets even bigger as you go out further and further. The key here with technical analysis is to get in sync with the markets, to try to understand and learn, not to impose your beliefs on them. And knowing when to be in the markets is almost as important as knowing what to be in. If you mistime yourself, it doesn't matter if you were right, in the long run. If you get stopped out first, then your entry was poor or your timing was poor. And technical analysis is used to hopefully hone in our entries to more of a razor-thin entry precision. We want to be snipers. And look, a lot of people are like, oh, I want 20, 30 strategies. You don't need all of that. Start basic. You have a core handful of really good technical strategies and setups that will make you as a trader. Any more will overwhelm you. You can't watch them all until you get more experience. So you don't need to worry about getting complex and fancy with things. I'm just telling you, I only trade at X amount of setups and they work. And then if the market shift changes, then you need to take those setups and tweak them. You never need to revamp and rehaul things usually. You just need tweaks and adaptations. So there are two generally approaches to technical traders. There's system-based, which is quantifying the market, applying a rules-based approach, almost becoming a computer yourself, having very specific rules. And then there's more discretionary, placing a high confidence in being able to interpret the market and make adjustments as needed. This isn't about memorizing chart patterns, but understanding the motivations of market participants. Remember, the goal here is not to create a system, but understand how to do analysis properly. I'm not here to teach you, well, when it breaks this and it pulls back and does this, you should buy and set your stop at this percent. No, I'm teaching you, well, this level set up and it broke and then the stock did this. Why? Why did it do that? What is the market doing? What does that mean for the psychology of the stock? And how can you use that to understand the market participants, and use that to try to anticipate what's coming next? John Maynard Keynes has a really, really great quote, and I know we've said this probably 100 times on our podcasts and on our morning videos and everything else we do. The markets can remain irrational longer than you can remain solvent. So you cannot be stubborn. You cannot impose your will on the markets, because the markets will break you if it wants to. The market will inflict pain if you let it. And so we're here to understand the psychology of the market and the psychology of the participants. So let's dive on in to the bread and butter here, and that is charting. And then we're going to kind of get in a little more specific, talk about supply and demand and how that really creates support and resistance, and then how you can trade some of that stuff. First off, because look, we have a lot of new people here. This is obviously beginner day trading. I want to talk about some of the types of charts. Make sure you understand the anatomy of a chart and what you're actually looking at when you look at a chart. Candlestick is really the one that you should hone in on. That's what 90% probably, I'm making that stat up, it's like what 90% of day traders out there use. A lot of day traders use bar charts as well. Those are actually probably just as good, in my opinion. Some people use line charts, tick charts, point and figure charts. There's like 100 different kinds of chart styles out there. I'm not going to cover them all, but I'll give you a couple examples of some. So what are the components of a chart? And you don't have to worry about this. I'm going to pull up a chart, and you'd be able to look at a chart and understand, well, the stock ticker and the company name is obviously usually on the top left, and the time is at the bottom, and the price is on the right, and you can see the volume down there. These are kind of the actual nuts and bolts of the chart, and just make sure you understand where everything is. So this is what a typical chart would look like. Congrats, you've seen a stock chart. The price is obviously on the right-hand side. You've got volume down there in the bottom right, kind of that long bar underneath the price. You've got the time accruing across the bottom, obviously. None of this is new. I'm not going to hone in on this, but if you haven't seen a stock chart, take a moment, look at it, familiarize yourself with it. This right here is your battleground. This is your church here. This is where you're going to be spending all of your time as a technical trader. So I need to make sure that you know what it looks like. So why look at charts? Well, we look at charts because you can see where a stock has been. And if you see where a stock has been, because obviously charts are, backward looking in nature, we're seeing what it's done in the past. Well, if you see that, you can then anticipate where it can go and how fast it can get there. I'm not going to look at a stock, that moves 10 cents a day and, does millions of shares and is oversaturated and doesn't move. And there are stocks like that. There's ETFs like that move a penny a day and do millions of shares. I'm not going to buy into that and expect to get 50 cents a point. You need to understand that. And it really, looking at a chart helps you understand what you can expect out of your trade and what you can hopefully rationalize, because history does rhyme. Obviously, the chart is the main tool of the technical analysis traders. And then what you can do with that chart is what we're focused on. Putting studies and indicators on there can help give you estimates and probabilities. We're not predicting. We're like a gambler. We're like the house. We want the edge ever so slightly in our favor. You're not going to have a 100% win rate. Hell, you might not even have a win rate above 50%. But if you do it right and you have a good trading system based on technical analysis, you can still make money with a 30% win rate. So, that's the best part, is you don't have to be right. You just have to, that more than you're wrong. You just have to interpret the charts, have a good trading system, and, understanding this technical analysis will help you develop that trading system. Before I dive in a little deeper, let's take a moment and look at that candlestick, like that example I showed you. This is the component of a candlestick for those who don't know, because you might say, candlestick chart, what the hell is that? Well, the body of the candle, that's that big square in the middle there, is the open and the close. The wicks on the top and the bottom there, obviously sprouting out of it, are the high and the low of the day. Now it's going to be colored or filled in some way so that you can identify, well, is the open on the bottom or the top of the candle? If it's green, that means that it closed higher than it opened. And so the bottom of the body is going to be the open and the top is going to be the close. If it's red, it's vice versa. Obviously, it closed higher than it opened. This is kind of basics, but you need to make sure you understand how to read a candlestick. What are some of the other types of charts out there? Well, there's the line chart. This is what you'd usually see on TV, on CNBC, the talking heads. They'll put the line charts up. It's less noise. They don't want to confuse their viewers by putting candlesticks up there and all of these different patterns. And so what it's doing is it's stringing closes together of bars. It's still giving you a lot of the same information, but it's just stringing the close together. It doesn't give you the high, doesn't give you the low. It doesn't give you a lot of information, but it smooths it out for you. There's also another type of chart. This is an interesting type of chart. I just wanted to mention it because it's kind of unique and it gives you just kind of a good scope on the very unique types of opinions there are out there on how to view charts. A tick chart. And this measures the amount of trades per bar. So whereas the candlestick, if I go back here, that bar right there represents a measure of time. That is either 1 minute or 5 minutes or a day or a week or a year. However, the tick chart measures an amount of trades. So if you have a 500 tick bar, that means every one of those bars there is 500 trades. Time is not considered. It could take it a year to do 500 trades, in which case after the course of a year, there's only one bar. It could take, a course of seconds to do 500 trades. There's not going to be an even amount of bars throughout every day because it's going to take a different amount of time to do 500 trades. Time is not considered. Otherwise, it looks just like a bar chart. And here, they use this because you can visualize the volume on breakouts and moves. It's a very unique system. I've never really got into it. I tried, but it just wasn't quite for me. But some people love it because, obviously more bars means more trades are firing off quicker, and you can visualize the amount of participants a little quicker. It's a very interesting tool. But I just want to give you kind of an idea there. If we're talking about charts, it's really important to talk about chart time frame, because when you're charting, understanding your time frame is key, because like I said, that bar or that candlestick could be anywhere from 1 minute to 1 year. You need to understand that you're using the appropriate time frames. Day traders shouldn't be trading executions off of the daily chart, or vice versa. If you're a swing trader and you're trying to buy something for the course of a year plus, you don't need to look at the minute chart. You don't. Look at the hourly chart or a couple of, I believe it's tomorrow's class we actually go into, well, if you're this type of trader, this is the type of time frame they talk about and the moving averages you should use. We get into some of that. But first off, you need to understand that, there are appropriate time frames and appropriate systems that you should be looking at. There's another system that we're going to be talking about a little more in depth tomorrow, and this is very key. But understand that using multiple time frames to analyze that trade is going to give you such an edge like you wouldn't believe. Looking at it first on the daily and then zooming into the hourly and then zooming in further to the minute will give you a really good sense. So understanding that time frame is a big part of charting is really going to help you kind of one-up yourself in your learning curve there. So now that you at least understand the basics of charting and what is a chart and the components, let's talk about supply and demand. Because before I can even talk about resistance, support, and setups, you need to understand that this right here is the force of the market. It is a basic and core component of literally everything in the world to an extent. The price is constantly fluctuating in a stock or in the economy or whatever as demand for the good or the stock rises and falls compared to the supply. Understanding that a stock is only going up because the demand for that stock is rising faster than the supply, the people selling it, can keep up with, that will help you really at least understand why something's moving. I'm going to give you, and I apologize if some of you feel insulted by the stupidness of this example, but this really helped some of our people who really had a difficulty understanding supply and demand. There are people out there who do have trouble, so bear with me for a moment. Imagine that, bananas are out there and they sell for $5, and a lot of people love bananas and they buy them. Well, the demand increases for bananas suddenly because a health study has come out and says, oh my God, you eat bananas, you're healthier, you live longer. Well, that banana supply is now going to decrease as people are accruing it up. So the sellers say, I'm going to raise my price now to $10 because I want to make more money. Why would I sell my banana for $5 when there are someone out there willing to pay $10 for it? So the demand now starts to decrease. Someone's like, well, I want to be healthy, but I'm not paying $10 for that banana. So as the demand decreases, people aren't willing to buy the bananas for $10. The supply starts to build back up. So the seller lowers the price, and round we go. And that's stock trading in a nutshell. Maybe bananas reach $10 and now no one wants to buy them, so they buy apples instead. Guess what? That's like stock trading. One stock gets too pricey, someone goes to a competitor and says, hey, that stock actually looks pretty cheap. And that's why you see, similar stocks move with the same headline. A stock could go up based on a study or a news catalyst that another company has had, and it's not even related with. This is the core component of supply and demand. Thank you for sitting through my banana presentation. Now, supply and demand in the markets. Well, the movement of the stock, like I said, is literally the battle of supply and demand. People are buying the stock up, driving the price up. Demand is rising faster than the sellers can supply it. So a good example of supply and demand getting a little funky in the market is what's called a low float. What if there's a stock out there, and I think Mike's already talked about these a little bit, that has such a small share count out there. The supply is it's artificially low. There's not that many shares out there, so it's very easy for big traders to get out there and manipulate this stock or move it around. It's still supply and demand. It's just now you've constrained the supply, so the demand and the price is very easy to manipulate. Coincident, on the other side of things, there's stocks like Apple that have millions of shares for a float. And the fact that they have that means that it's hard to manipulate the stock and manipulate the demand. And so technical analysis at its key is just simply trying to identify the change in supply and demand. Where on this chart are the buyers stepping in? Where's demand rising and why? Where can I expect demand to fall off? Where can I expect sellers to start stepping back in? That's all we're trying to do here, folks. That's really the edge we're trying to gain, is understanding the flow between supply and demand in the marketplace. So trading supply and demand, well, let's talk about the same kind of scenario in stock news. Well, why is the supply and demand changing in a stock? Maybe it has news. Maybe the perception of the company's changed. There was a scandal. Maybe the fundamentals have changed. They acquired a new contract or got a new patent, or maybe it's just simple hype. It's being pump and dumped, or people are really hyped about Tesla and Elon Musk is tweeting, God, that, we're going private, even though they're not. All sorts of different things. What if a stock has great news? You see the headline hit, you're like, oh my God, this is great. And the stock's not moving. It happens. I guarantee you it'll happen. You'll see it. You'll see a headline hit. You're like, oh, that's awesome. Why aren't we moving more? Maybe it'll move a little bit, but that's because there's not that much demand, or there's too much supply. People have had this stock for a long time. They're trying to take profits into this news cycle. Why would these people be selling into such a great news event? Maybe they think it's a little overvalued, or maybe this news has been known and is already baked in. Understanding why the demand's not rising or why the supply is increasing is what we're trying to do here to give us an edge. Now I want to go back and talk about volume, because like I said, volume is the forgotten stepchild of technical analysis, but you need to understand that it's a direct reflection of demand. If the stock is moving but there's no volume, there's no one participating in this. And maybe it's just that the supply is so low that it's easy to manipulate, or no one really is selling, so the demand's easily able to push it up. More volume is good because it means more people are participating in this move, and it's got more oomph behind it. This is kind of a little saying that I just came up with as I was making this PowerPoint. I actually thought it was quite fitting. If price is king, then volume is the will of the people. Price is king. You're not going to make money without the price obviously being in your favor. Now think about this metaphor. A king without the people won't be king for long. This price, yes, it might be breaking out, but if there's no volume, if there's no people behind this price, if there's no participants rallying it, it won't sustain itself. Any trading setup, breakout, chart pattern trade needs volume. And if you watch our podcast, you'll hear us complain all day about, God, I love this setup, but there's no volume. There's no participants. Maybe I'll watch this stock tomorrow, but the volume needs to be there. That's not, an accident. That's not us just pontificating. It's us saying, like, look, if there's no volume, it's not going to be fun. The stock's probably not going to move. I mean, it might, if people aren't paying attention, but, it has a much better chance of being real and the move's not wicking you out and being fake breakouts if there's participants that are in the way. Like I said, participants need to move otherwise for it to continue. And price won't rise without any demand to drive it. So I talked about stages of the market. The market repeats itself. It enters stages and patterns. Well, this is it's not really a theory of the market. It's true. It's, psychology of the market, but it's not as cut and dry. Maybe some people might disagree and say that there's extra stages within, but there are really 4 key stages of the market. Accumulation, and this can be said about a stock as well, but we're talking about it in terms of the market just at the moment, but you can really apply this to anything. Accumulation, markup, distribution, and decline. So let's dive into these, show you a chart pattern, and then get a little more specific on supply and demand here. So accumulation. What is accumulation? Well, it's following a period of decline. And this is, a neutral period marked by contraction. It's there's no edge. The stock is just moving sideways. And you'll see this if you look at a chart. The stock for days, weeks, months, maybe even the market has just been moving sideways. They're not going anywhere. They're not really driving it higher. They're not driving it lower. The moving averages are all crossing around each other and snaking around each other. It's indecision. It's range bound. Volume slowed. The market isn't paying attention to that stock. This happens all the time in the market during slow summer hours or in certain stocks because look, the market can only pay attention to so many stocks at a time. And so volume will slow. And what's happening here is people might be accumulating, or there's a little bit of changing of hands, new participants are maybe stepping into the stock, and eventually there's markup. The buyers are back in control. We're making higher highs and higher lows. Demand is surging. The stock is clearing the highs of stage one. Suddenly a large group is caught off guard and, oh my God, let's chase the price. I want to be in. I don't want to miss this. I have FOMO. Let's go. And you see momentum traders pile in, and they all start increasing the volume. And there are different phases within here of the people who caught it first, and then the people who saw it after a meet of the move, and then the late idiots who buy it at the top. These people are all within this move. But this is the markup where the demand is suddenly surging, and that could be for a number of reasons. Maybe a big buyer stepped in, and news came out, technically based, whatever. Then you've got distribution at the top. The market has now exhausted itself. The sellers have become more aggressive. People have locked in profits. They're like, oh my God, I'm up 100%. I am more than willing to sell to idiots buying up here. And the market starts to become neutral again. Now bulls and bears are fighting for control. You're seeing the short and medium term kind of moving averages start crossing over each other. Now you're seeing kind of people distributing shares back and forth, maybe, and the demand slowing, volume slowing down. Now you might get another period of accumulation or markup after if demand can resurge, or most likely you'll get a stage of decline, which is, the lows of stage 3 are breached, and now there is no more demand. There's so many people wanting to sell, and no one else is willing to buy because the momentum slowed down and it's not as sexy. Day traders and momentum traders have moved on to the next great stock, so demand's gone. So now we're setting in lower highs and lower lows. What do these phases look like on a stock chart? Let's bring it on back to a chart. Show us back, show us more charts, Nick. Come on, we're bored. Well, here is, whoa, there we go. Okay, so here is Apple. Everyone knows Apple. If you don't know Apple, I don't know what the hell you're doing. This is a pretty good visualization, in my opinion, of, the 4 phases within the span of almost a year. Look at that, for what, 2 months, almost 3 months, Apple accumulated sideways, complete sideways range-bound action. Obviously the volume's not doing anything. It's summer months. It's just moving sideways. Bam, suddenly Apple breaks out. Looks like the news catalyst was earnings. We gapped up. We're running. Suddenly people are chasing Apple. You see the volume pop and surge a little bit. We're making higher highs and higher lows. Oh my God, we're marking up the price. It was a little short-lived in this case. It only went up for a month and a half. And then we got back into distribution. Suddenly people are battling again. The sellers have stepped back in. People who may have been accumulating earlier are now up, 20% in Apple, which is great return for such a big company. And now we're suddenly seeing that distribution again. Now you've got markdown coming. And it looks like, yet again, the news catalyst in this case was earnings. It's lasted long enough. This quarter of markup, this period from markup and distribution lasted a full quarter. And now earnings came out, and it looks like it sent it down again. And suddenly demand's dried up. People aren't buying the stock. Volume's actually surging on the way down as people are drastically trying to sell, let off their shares, and it actually went lower than during the markup and accumulation phase. This is just a visual representation, understanding what phase, why does this matter? This is kind of weird and academic. Well, understanding the phase of the, that the stock or the market is in is going to help save you. If you're trying to buy Apple during that period of accumulation, if you're trying to day trade Apple, it's probably not going to move that much. It's not going to be that great. Now, if you're buying in anticipation of a breakout, you're looking for that markup period, all right, maybe you've got some thought there. Or if you're trying to buy Apple during the markdown, what are you doing? You need to understand the phase that this stock in this market is in. So now let's move on and talk about supply and support and resistance. Now this is really kind of marked moments in a stock chart. Now we're actually getting into some real technical analysis. I know some of you have probably been falling asleep during supply and demand. You didn't know you were coming to an economics course. I'm sorry. But we're talking about the visualization of supply and demand in the markets here, which is support and resistance. This is, people are probably also like, I've heard of support and resistance. I know you draw the line, you touch the points, great, you buy there. Well, this is the most basic of technical analysis theories, but it's used in a core component of probably over 90% of all other technical setups out there. Every other indicator out there and every other setup and chart pattern is completely irrelevant if you don't understand what support and resistance are, because they're all basically used as support and resistance, and this is the core concept that drives all of this. So what is support? And hopefully you learned something new in here if you didn't fully understand it. Support is technically a level that the stock cannot trade and hold below. It's kind of considered the current floor in the stock. I'm not saying the stock will never go below it, but it's a price right now where the demand starts to overwhelm the supply over and over again. A stock goes down and bounces and goes up briefly one time. That doesn't make it support. This is a part where, you see the price come down. You see Apple come down to a certain price. It bounces off that price and goes up. It eventually comes back down. That same price steps in again and it goes back up. A little bit of a support example here. Stock A over the past 3 months has traded to a low of $20.25 over 10 times. Each time it bounces off and moves higher. Maybe it moves up 25 cents higher, 50 cents higher, $1 higher. That, does matter, but not as much. The important part is that it keeps bouncing off. Is this support? Yes. And obviously, we'll visualize this with some stock charts. I'm going to show you some trades that we made off support and resistance in a little bit here. But first, I want you to identify, understand, well, how is support formed? Because yes, to an extent, this can get a little subjective. But price is king in the end. You are trying to identify, where is support forming and why is it forming? Well, maybe at a certain price in Apple or the stock that you're watching, there's a lot of big players sitting there and they've got a whole lot of buy orders sitting there. And that happens every single day. I'm going to show you a chart in DraftKings, and actually someone, Jimmy called it out to us on a text, and it was spot on. There was a spot where sellers were just sitting there, and they were perched there, and you could see people trying to eat through the supply, and they couldn't, and it caused the stock to go down, because there were big players there. Maybe there's a fundamental reason why support's formed. And this happens. There are stocks out there, and there are types of stocks out there that if they decide to liquidate, if they decide to bankrupt or whatever, that they have in their prospectus that they will pay you out X dollars per share. Specifically, there's these blank check companies or SPACs. If you don't know what they are, don't worry about that. That's a little more complex, and we'll cover them in a couple courses here, but they're essentially stocks that are out there to buy another company, and if they can't buy another company within, I think, 2 years it is, then they liquidate at $10 a share. So that's the worst you're probably going to get. So there could be fundamental reasons. There's emotion and memory in the market, and I'm going to show you some interesting things where there was an important level set in. Years later, a stock is finally revisiting and crashing down, and it bounces off that level. The market has a memory. The market has emotion and memorizes some of these levels. So when you're analyzing support levels, how do you analyze support levels? Well, obviously, if you've heard some of this before, you will know that the more times it touches that support level without breaking that support level, the better. The stronger that buying looks, the better. The cleaner that demand is, the better. The extent of the bounce off of that support can be pretty key. If it hits that support and bounces off a little bit, but not really, it can't get away from that support level. There is demand there, but there's not enough demand to drive it higher and further away, and that can be a problem, obviously. The volume done at this support level can tell you and show you just the sheer amount of buyers that are there. A stock may get down to a price, $20 a share, and it might go a little higher, but it didn't do any volume. That doesn't mean there's necessarily support there. It just means that people didn't try to sell really there either. Maybe there just happened to be a little more demand to overtake the little bit of supply that was hitting at that level, but it wasn't enough. Now, like I said, the more times it touches without breaking, the better. There's a caveat to that. because also the more times that support gets tested, the weaker the buyers are going to get. I mean, think about it. There's only so much demand out there. Eventually, if that supply is still pumping out, people are still selling that stock, and suddenly the buyer's like, well, we got everything we want. I don't want any more at this price. Well, then suddenly the demand's gone and it's going to actually crack through that support. So there's a balance here of touching it. Some people say touching a support level 3 times without breaking in a short period of time kind of makes it support. Others have other rules. I want to put a little caveat in here because, look, we are in the 21st century, let's be honest, and rarely it's going to be perfect anymore. There's high frequency trading, machine trading. There's a whole lot of manipulation out there. Mike's already shown you examples of wick outs where you think you've got like the perfect entry, but like it suddenly kind of just drops all of a sudden and comes back. There's fake outs all the time in the market, so it's up to you on a case-by-case basis of how picky you want to be. It really also can depend on the stock. Some stocks are naughtier than others, and some are more volatile than others. But obviously, you'll start to know it when you see it. And I want to go through just a handful of slides here and show you some examples of the market having a memory. Now, this is MSM. This is just a random one that I kind of stumbled upon, and I was like, oh my god, this is actually pretty nice. Now, look at the first yellow arrow on the left there. That is, I believe, 2017. 2017, that stock went down to about almost $65 a share. Took a nice little bounce, made it all the way up almost to 100. That's not bad. And then kind of chopped and slowly declined. 2 years later, MSM finds its way back down there. Now, 65 at the time, I wouldn't maybe, it did bounce pretty high off of that. So it's a pretty nice level. It didn't test it that many times, so it's hard to say that's a key support level. You shouldn't be buying in front of 65 in anticipation of that buy happening again. But look at that market memory. 2 years later, at that second arrow, we bounced off of that level. That's not a coincidence. People say, oh, it's coincidence. Trust me, the more you're in the market, the more you'll see this. It happens every single day. The market has a memory. That right there is probably now a support level. Now, yes, this support level's happened over years, and maybe a year later it might go down there. Those buyers may not be there anymore. Maybe something fundamentally has changed in the company to change the perspective of people who might want to buy there at 65. But, knowing those levels, the market's dropping, you don't have any new levels on your screen. You need to figure out, well, where might buyers step back in? Remember, we're using technical analysis to anticipate. If I knew that level was there 2 years ago prior to the stock getting there, well, then you know what I can do? I can set an alert there. I set an alert there, it gets there. I can then spend the next couple days or weeks watching that stock trade there. And maybe I have, you watch it support there over the next couple of weeks, and suddenly it starts moving higher. You're like, oh my God, the support held, I can buy. And I've got a very clean line where if it violates that, that can be my stop loss. Congratulations, you've just made your first trade. So that's a good example. Another one is Microsoft, and this is a little bit of a shorter time frame, but look at, just above $40 a share here. Over the course of less than a year, we bounced off it 3 times. And each time it moved off at a varying amount. And I tried to use some arrows to kind of signify, look, you can actually kind of see the volume perk up in some of those cases, especially the first time it tested. Volume surged back in, sent us higher. Second time, we're still capitulating around. Third time, looks like Microsoft on that third time was actually dropping pretty hard into that support level. Look at the volume step in on that big green bar at the third arrow. That's some serious volume on that Microsoft bounce. That support level still held. There was still clearly a lot of buyers there to absorb that supply. That's not bad. That's a pretty good support level right there in Microsoft. And that's just over the course of a couple of months. Again, you don't blindly buy there in anticipation. This is, yes, we are trying to anticipate, but we're anticipating where to watch for a setup to occur. So now we've talked about support. Well, what is resistance? And, it's exactly as it sounds. It's the opposite of support. It's the price that the security cannot trade up or hold above. It is, if the support's the floor, then the resistance is the ceiling. And, kind of going with the same trend, this is going to be the spot that the supply is overcoming the demand. Apple goes up, hits, $90 a share. Suddenly it just deadlocks like it hits a wall. And it's like, well, what the hell just happened? This thing was rocking and rolling, suddenly it just can't move. That's because suddenly there's sellers there. Maybe it's a big seller, maybe it's a whole bunch of sellers, maybe there's a technical reason it's there, who knows? But we're not necessarily there to try to get into the minds of that big seller. We're trying to identify that the big seller is there, and that it is an important level, and that this is resistance. So maybe we should take off some of our long, or maybe we should figure out where we're going to start taking profits if it drops. Example of resistance, just like the support. Stock A can't trade above $25.05. Tested it over 5 times in the last 2 weeks, starts dropping. Is that resistance? Yes, you should know that. Hopefully by now you should at least have a general understanding. So analyzing resistance is going to be like analyzing support, but on the upside. Volume and the extent of the drop after testing it is going to tell you a lot. The more tests, obviously, the better, because you have now tested that seller. You have hit your head into that stock, rather, hopefully not you, have hit your head into that ceiling 10, 20 times, and the ceiling isn't coming down. You're not breaking through. That's a pretty well-built ceiling. Now, obviously, the more you hit that ceiling, the weaker it's going to get. So you got to hope that you're going to start dropping soon. So you don't necessarily want to anticipate, but it's important to note. People are selling there. People are shorting there. There's maybe a big seller sitting there. Maybe, like I said, there's a fundamental reason. Maybe that's a certain PE ratio or something weird sitting up there. Maybe it's a mental price level, and this happens. A stock getting to $100 a share might actually reach some support or some resistance at $100 a share. It's a big psychological level of a stock becoming a $100 a share stock. $50 a share, $100 a share, $1 a share. These whole big numbers, might signify something, and you might have people saying, all right, well, I've been in this thing since $80 a share. It's a $100 a share stock now, so I'm going to take my 20%, my 25%, and I'm going to walk. And that happens all the time. You will see it all the time. So let's take a look at some charts, some examples of resistance. $41 in NEM. This is Newmont Gold Corp. This is a gold company. I've tried to show you several different types of companies across different sectors here, so you get in a sense that this happens everywhere. And this is on the daily. 1.5 years later, that stock, topped out at $41 a share back in 2017. Going a year and a half later in 2018, it manages to rebound nicely. It's had some good earnings under its belt. Some people have bought down there, and they're up nicely. Deadlocks right back into that ceiling. Sorry, the sellers are there, or sorry, the market's remembered that this is kind of the part where people don't want it anymore, and the supply overwhelms the demand, and it drops. Now, some of you may be saying, well, Nick, this is great, and this may help us, day trading on the day that it hits the ceiling, but this is a day trading course. Well, I just want to show you, obviously these resistance and support levels are going to give day trading opportunities, but you can see support and resistance on the intraday as well. For those who don't know, when you're looking at Thinkorswim, that shaded section in the middle is pre-market and after hours. Obviously, we've talked about this in some of the courses. You should hopefully know what that is. They don't just trade 9:30 to 4. Anyway, look at that 188. It was resistance on the stock the day prior, and this is a 5-minute chart, so every bar here represents 5 minutes, for those who didn't catch that. The top line there was very nice, clear resistance. Yes, it did peak up over that in the pre-market and in the after hours in that shaded section, but remember what we said, volume. No one really trades in the pre-market and after hours, especially that late. Look at the volume. There's no one participating there. The sellers aren't there in the pre-market and after hours. And yes, if it opened up above there, then you would hope that resistance would hopefully, maybe become support for you, or, maybe it would then go up because the sellers have now been kind of skipped over in the pre-market and after hours. That absolutely happens because they aren't there. But we opened back below the next day, and lo and behold, the sellers were still there. You also had support, the same support level. Look at the lows of BABA on the previous day at kind of that just above 185. Look at the wick at the end of yesterday. Wicked down there to the T, it bounced off. And then look at the following day, the following morning, dropped like a rock, bounced off of that level almost to the penny. The market has a memory. Support and resistance can be used all the time. I just want to show you, make you feel good about you're learning something valuable here because it's the core fundamentals of technical analysis. So support and resistance, like I said, the more it's tested, the weaker it can become. But I want to warn you not to go guessing that it will break the 10th time and anticipate. Yes, there are times when you can anticipate. That gets a little more complex. It's a little more of an advanced thing because what you should be doing is if the stock is at a key resistance or support level, you should be watching the price action. If you know what the time in sales is and you can actually watch the trades go off and watch the level 2 and actually see the bid and ask, watch it go off. Even if you're just learning, you can actually see the volume go off. You can see the orders go off at that big level, and then suddenly you'll see it go the other way, or you'll see that seller disappear and it'll suddenly take off. And so you can use those tools to help anticipate and get favorable price action. You just need to understand that when you're anticipating, you're risking a little bit more. Your win percent might go down unless you have some kind of really good tell out there. Because look, if there was a really big support level and you wait for it to break before you buy, you're not going to get it right on the other side of the support level or resistance level or support level probably. Let's be honest, because it'll probably snap through pretty quickly. So there's a balance here. Now, a little bit more about support and resistance. This is something that's really important here. If there is a really important resistance line and a really important ceiling on that stock. Imagine if you break through the ceiling, you break through the roof of your house. Well, now coming back down, you would hope that roof would now act as a floor for you, and vice versa. If a resistance level in a stock breaks, it should actually now become support, and vice versa. If you break through the floor, that floor now kind of becomes your ceiling as you are now below it. If we go with the house metaphor, the market remembers these inflection points, and it's not going to be like, well, we broke through, no one's going to care about that level anymore. Absolutely not. People will still pay attention to that level. Many traders may see the break of that resistance line. It may see the stock push through, but you need to understand we're in a very whippy and unpredictable market with HFTs and computer algos and such, and a lot of manipulation. A lot of traders wait for the confirmation. They wait for that confirmation that it comes back, tests the level, and then bounces. And I'm going to show you a couple chart examples. We are almost there, I promise. Some people wait on different types of confirmation. They might wait for a break, and it spends amount of time above there before they're convinced, all right, this isn't fake. We've spent a day up there or a week or a month, depending on your time frame. Maybe they look for volume. We break through that resistance level. Are there participants up here, or is suddenly the stock not doing any volume? Obviously, no one's up there. Or price action, or a combination of things. Obviously, the more you have in your favor, the better. So that's going to be good. So wrapping it all up, bringing it all together now before I show you a couple technical examples here, levels may appear, at easy, and that's supposed to be the word easy, to digest numbers, whole and half numbers. It's going to be surprising, but think about an IPO. For those, we've talked about IPOs already. The initial public offering, the time a stock first hits the market. What else are traders going to look at? There's no previous technicals. There's no previous information on this stock trading. So you actually see that happen pretty often in IPOs. If you look at a stock that's traded maybe just for 5 days, go back and look at the stock chart on those first 5 days. You'd actually be pretty impressed at how well it holds wholes and half numbers because it has nothing else to go off of. There is a theory, and I believe this is the right term for the theory. It's apparently very big in Forex, Tyler told me. That's the quarter point theory. And that is, that these quarter points, the 25 cents, 50 cents, 75 cents, whole number, can be decent levels to look at and inflect on intraday. Now, obviously, some of these stocks, they trade so much volume. There's so much HFTs and manipulation that, you can't just buy at the quarter point blindly. That would be stupid. That happens. There are big mental numbers in a stock, $100 a share, dollar share, etc. That can actually come into play. And there were stocks, Square, SQ is the ticker, just broke $200 a share. It actually pulled back from $200, I think, twice before it broke. Tesla, I talked about Tesla actually. Tesla just finally burst through $500 a share. It failed at $500 a share 2 or 3 times before it broke through. And there's no fundamental reason That's pure technical base. That's pure like $500. We're about to break. We're over halfway to $1,000 a share stock. That is pure just number there. And understand that happens. It may not happen in the stock you're trading, but it's something to be aware of. You're long a stock and it's coming into $100. It's not necessarily a reason to sell, but it's a reason to start watching and be like, all right, well, if it pulls back to here, maybe I'll take some profits or I'll exit. Something to keep in mind. All of this wrapped up. Look, we've just described the psychology of the market here. We've described the psychology of why the stock goes up and down, and something that we're going to be talking about a little more in depth tomorrow is these support and resistance lines. They don't need to be flat horizontal lines. They can be trend lines at an angle, moving averages, studies, indicators. There's all sorts of complex ways you can now identify support rising and resistance rising or going the opposite way. They don't have to be horizontal, and that's important to keep in mind. It's something we'll touch upon more tomorrow. Let's take a look at a couple of charts. I just threw some in here for fun. Some of these we did take trades off of. Some of them, we looked after the fact and we really liked them, so we saved them. But some of them were just so clean, and it's such a good example that, look, even if you don't believe in technical analysis, you can't look at some of these charts and be like, oh no, that's random. That's complete randomness. That's all right, sure. Aflac. Good example here, $46 a share and $42 a share. Look at the yellow arrow, that resistance at $46 a share. Clear resistance on the daily there. Obviously, since January of 2018 until August of 2018, it tested that level, I don't even know, like 6 times technically, almost tested it more. Couldn't get above. Suddenly, it gets above on a news catalyst, which was earnings. And now suddenly, lo and behold, oh my God, $46 became support. It's magical. And look, it may not have. It could have gone up there and suddenly the demand could have dried up. Who knows why the demand dried up. But if it suddenly got back below, which it eventually did 2-3 months later, that's a good sign. Or, that happens. And, it got back below and, Aflac just couldn't get away from that level. The volume really wasn't that high compared to, I guess, earlier in the year. It was kind of going into the end of summer, so maybe there just weren't that many traders out there. But, there just wasn't enough oomph to carry it around. And look, we broke right back below it. Lo and behold, the 42 support was still there. That 46, that was resistance, then support, now became resistance again. And then later next year, February next year, we finally broke it. For some reason, who knows? Maybe something changed. Maybe the market environment changed. You got to keep in mind that maybe the market was just not that appealing to buy stocks at that time. Maybe it broke in August, but meanwhile, we're in some kind of crisis, and everyone doesn't want to be in stocks. They want to be in cash or gold, and so you're not going to get people that accumulate. It doesn't matter if the technicals look great, and then maybe in the next year it did look great. The market was in a buy period, in a markup period, and so people started buying Aflac, and congrats, it went from 46 to 56. You made 25% in half a year if you bought that breakout. I mean, I'm not saying you would have held the whole way. I'm just giving you an example here. So great example of that working. Now let's look at NDAQ. This is NASDAQ. This is not the Qs. This is the company NASDAQ. I drew a couple levels here. There's that big support, just below 62.50. I think that's about $62 a share. Nice big resistance at about 72.50. I highlighted in white there the example of quote-unquote confirmation. The NDAQ broke that 72.50, got up a little bit, moved away a little bit, pulled back eventually, and in November and December of 2017, retested that resistance. That resistance held as support, and it started to move away. I'm not saying that was a reason to blindly buy. Everyone's trading strategy is different, and it depends on, again, the market environment, the demand, the supply. But it ended up going from 72.50 to 90.5, and I don't even know where it is now. It's probably higher. But good example of, again, support and resistance. So question, is support and resistance a self-fulfilling prophecy? Is it the fact that we're looking at it like this, does that make it more support? Well, like I said, there's emotion and memory in the market. We are irrational participants out there. People are going to look at that and be like, well, it bounced here, so I might just dip by here. And enough people see that, enough people think the same thing, that it does kind of happen. It is kind of self-fulfilling. If no one believed in support and resistance, would it work? Well, I mean, yes and no. Remember, 90% plus of the trading out there is computer-based trading. There's mathematical support and resistance that come into play very often. You might not realize that support is forming because of some mathematical reason. Maybe it's a moving average, maybe it's some kind of standard deviation away from where the stock usually trades, who knows? But it turns out to be good support nonetheless. And, in that case, maybe it isn't self-fulfilling, maybe it's more mathematical based. Now, caution you. When we're doing our technical analysis, if you're new to technical analysis and technical analysis trading, it's going to be very easy to become the Monday morning quarterback. And what that means for those who don't know, football means that, you look at someone's performance the next day and you say, oh, we should have done this clearly. Why did he do this when it didn't work? When if he did this, it would have worked. Yeah, we know that now, but you may not have known that and been able to discern that as easily in the time. And that happens on stocks all the time. Also, caution, using obvious support and resistance levels for your stops will lead to obvious stop outs. Like I said, look, it's easier than you think, but it's not quite as easy as that because, look, there are HFTs out there. There's manipulation. You'll get wicked out. There is kind of some give back there. And, you do need to kind of understand the feel of the stock and the feel of the market. You need to understand, well, the stock might wick out first or, they might try to do a short squeeze before they drop them out. And Mike's shown a couple examples of that. But you need to, just don't, we don't like using hard stops anyway, but it's a good example and good reason. Understand recency bias. Just because this stock failed to break resistance the first time you tried to trade it, should you trust it the second time? If it breaks and fails the first time, should you trust that breakout the second time? That's going to be really up to the stock. It's going to be up to you. It's going to be up to your trading philosophy. Sometimes I give stocks a 3 strikes and you're out scenario with a trade. To each their own in this case. I'm not going to tell you that you shouldn't trust a stock just because it was a fake breakout the first time. And then, sometimes you're just going to suck at trading some stocks. It happens. There's a couple stocks out there that I will take off my list. DraftKings, a couple of those guys, I just am not good at trading them. I don't know why, but I'll take them off my list. Also, I want to give you a little, not really insider information here, but there is caution here. Price discovery, especially as a day trader. The first 30 to 45 minutes of the day is considered price discovery. No one knows where the stock is going to go and where the buyers and sellers are in that first 30 to 45 minutes. The stock does most of its intraday trading volume in that opening time. That's when most of the people are buying and selling. The market has no clue where all the big buyers and sellers are at this point. Only the big buyers and sellers know where they are. Now, yes, they may be at some of those key support and resistance levels, but you need to understand that that first bit of time is usually discovering where the buyers and sellers are. So you might get more whippiness. You might get more wild moves, reversals, some choppiness. So if you day trade, just keep that in mind. We momentum trade very heavily in general right now because of the market environment, but especially during the open. I'm not trying to accumulate a long-term position in the first minute of the day because there could be some random ass seller 20 cents up that I had no idea was there. It happens, Part of this is the anticipation. Part of this is reacting as a trader. So just something I want to keep in mind. Let's look at a couple more charts here, and then I'm going to let you go. I know I've gone a little over. We keep doing that, but we want to really home in and hammer your heads in with some of this stuff. First off, I want to look at the actual market. This is the IWM. It is the Russell. Some call it the small caps. So this isn't like the NASDAQ or the SPY, but it is one of the more heavily watched markets out there. Look at that 170 on the Russell. 170, and I'm going to show you another chart of it. These are the last 2 years. So what you're seeing, that big drop, that is actually 2020. That is what we experienced with Corona recently. And I'm not saying you should have shorted at 170 and you would have predicted Corona and the drop there. No, I'm just showing you that 170 was there. It tried to get above at the end of 2018, and it looked like it was going to hold. And then we had a nice little pullback at the end of 2018 and a little bit of a rebound. And lo and behold, the beginning of 2020, that same resistance was still there. Now let's look at where we are right now in the IWM. Remember that 170 level? Bam! We've come back to it. We gapped up over it, and look, the gap up that sent us over that was not artificial, but it was vaccine headlines. And we've pulled back. We've tested that same 170 that the IWM could not get above prior to all of this, and it held, and we moved away from it. So, nice little example there of, look, it tried to get below 170, but that resistance that was there since 2018 and maybe even earlier, and we sold off there from Corona, and suddenly we're back there, has now become support. And, maybe you could have used that as a baseline for understanding a market shift there at that point. Good example of using support and resistance to identify key point inflection points in the market, and the fact that we got over a very important level there in the Russell. Let's look at an intraday example. This is something that Jimmy pointed out. So really, this was a beautiful example. It really is. First of all, $50 a pretty good technical level, or psychological level. You're halfway to 100, $50, whatever. But look at where that first arrow is. The prior day. Look at all the volume it tried to do there. It sold and sold and sold and sold at 50, and each bar here is 5 minutes. So it spent, what is that, 30 minutes to an hour trading there. And the fact that the demand couldn't overwhelm the supply, eventually the demand was gone. And the supply suddenly, there was way too much supply. Everyone had accrued this stock, and now they're like, oh shit, we're going down. And so people had to sell. So you saw the volume, those red volume bars start ticking up, as now those people had to get the hell out of the way. Well, look at the next day. The next day after that shaded portion, we opened up right there. We drove right up there. Lo and behold, the sellers, I guess, are still there. That was, I believe Mike actually took that short. So, props to him if he took it. But lo and behold, we reached that 50. The seller was still there, and you had a nice little basis for potentially looking to short this stock today. And now we had other indicators on there, VWAP or RSI or some other kinds of things. I'm not saying that that's reason enough. It might be reason enough to try a short, but it might not be. And we'll talk about more of, tomorrow we're actually going to talk about studies and indicators, and we're actually going to teach you what some of these studies and indicators are and what they mean. Because the more check marks you have in your favor, the better. But that resistance right there, that 50, is definitely a big check mark number one in your favor. Let's look at a couple setups on the daily and intraday. Look at the nice support in Lowe's. This is like the Home Depot competitor Lowe's, obviously, not the movie theater. 170 was nice resistance up here. That 150, kind of 4-ish, looked to be support. Had a nice little bounce here, nice little bounce here. Tried to reach it here. Bounced nicely here in November. And then Lowe's had bad earnings. You can see it down here. Bad earnings that sent us down here. Now, this is something I'm going to show you. This might be a little more advanced because it's technically fading a move, but this is a good example of, this is the intraday of Lowe's. We opened up below that key, kind of 154-ish. We went screaming higher on the open. Lo and behold, that support on the daily became resistance on the intraday. Even on the price discovery time. Yeah, we wicked through it. That happens absolutely all the time. Even if you didn't want to short in front of this, which I don't blame you, after you saw it kind of calm down, you could have used this kind of lid here as a rationale in that the demand was good, but it wasn't good enough. And now suddenly the supply's taken over and the demand has withered. You could have used that as a basis to look for a short for the end of the day, and you would have gotten a really nice short off of that. Let's look at another setup. This is AMD going into September of 2020, August of 2020, so not too long ago. AMD had a nice little kind of resistance starting to form. It's only tested it twice, but we've obviously moved away from it twice now. We're starting to push up into it. Well, AMD now going into the day trading side of things. This is the 1 minute of AMD. Look at these nice little kind of arrows I put in here. Obviously, that line is the big level on the daily. You could have bought, it tested it once here, pulled back, and finally got through and started making new highs. Even if you just wanted to momentum trade this, just trade the squeeze through, congrats. That was obviously a big resistance that we managed to push through. Look at the volume. Look at it. Look at that. That's beautiful. Look at that volume surge when we broke that resistance. Some people are like, oh, that's Monday. It is a little Monday morning quarterbacking, but it's just an example of how, you might have seen that in the time and use that as a basis for a trade. Hint, hint, I did on this trade. I pulled from some of my own trades as an example here. But really, really good setup here. Now let's take a look at what AMD's done now compared to that level. We actually broke through it, and a news catalyst sent us back down. We're still trapped in this range. This resistance, which we saw here, and we were like, all right, this might be resistance, proved to be resistance. We've tested it several more times since then, and we still haven't broken. AMD, I'm pretty sure, is sitting right at that resistance to this day. So if it happens to break it, that might be a pretty decent reason. Now look, like I said, there's other factors to this. Yes, AMD might break this resistance tomorrow, but what if the market crashes or there's some kind of headline or something like that? There's other things to consider. So breaking resistance might not necessarily just be a blind reason to buy a stock. You always have to have a trading plan and setup, but understanding support and resistance right here is a great example of, it's just the fundamentals and it's the key stuff here. All right, well, I've gone an hour and a half. This was the last chart I wanted to show you, so I'm going to let you all go. Tomorrow is another class. Tomorrow we're going to get into more technical analysis, and tomorrow's going to be studies and indicators. And it's going to be some chart patterns. We're actually going to say, well, when, you see this exact pattern, what does that mean? Why is a flag an important thing on a stock chart? What does that mean psychologically, and why is it a good buy period? When should you buy breakouts, and when should you fade them? What's VWAP? We talk about it all the time. It's on all of our charts. I took it off here because you wouldn't know what it is, but starting after tomorrow's class, they're going to be back on my charts because it's my favorite indicator. What's MACD, RSI? What are all the big indicators and technical things that people use out there when they're literally trying to use math to their advantage to gain an edge in trading? There is so much out there, and I hope that today was a good, at least basic fundamental of technical analysis for some of you. I'm sorry if this was all rehashed for some of you, but this is beginning for a beginner day trading series, and this is the core. This is the heart and soul of technical analysis, and this is how we make our living, folks, as day traders. This is understanding the psychology of the market. I really appreciate everyone tuning in. It's been a lot of fun. I will see you all tomorrow. If you really liked this, pop a like on there. If you're new and watching this and you haven't seen our stuff before, just subscribe, turn on notifications so you know when we're dropping these. We drop these Monday through Thursday, 7 p.m. Eastern. And we're here with our podcast every day as well, and we answer questions in the chat. Drop a comment on the video afterwards if you're watching this late and you have a question. I check the comments every day. I will see you all tomorrow. Thank you for tuning in. And remember, as always, safe trading.